Welcome to TheoTrade. This is Don Kaufman. It's November 6, 2019, and you are watching the TheoTrade evening video. There's about 15 minutes to go to the cash close. The S&P Futures, well, people, they are massively unchanged in today's trading session. Once again, kind of a light volume session. Not a whole lot going on the S&Ps, which is precisely why I'm going to describe to you risk reward, just terrifying traders and investors for these specific reasons. If you've been listening to really any major media source involving financial markets or reading anything about financial markets, there are a ton of marquee kind of traders, investors discussing, the latest market, shall we call up move, inclination, blistering move to the upside, whatever you want to call it. The S&Ps have flown to the upside for the entire month of October. And people, there's just no question. I've been in this business a long time, and it absolutely does terrify you when you see a move this drastic. Let me bring you in to specific scope of why. So, a lot of people that'll come out, they'll probably cite things like it's valuation, it's this, and things are becoming unrealistic over here. Well, the backbone really behind all of that has everything to do with risk reward. And I'm going to try to elaborate and kind of enunciate precisely what I mean by that risk reward, and a lot of what, professionals in this business see right now that really does terrify them. And again, everywhere you turn right now, media, you're bombarded by a little bit of doom and gloom. Let me get to, again, precisely why. One of the first things that I want you to kind of think about and measure along with me here is some of the most recent move, specifically inside of the S&P. Now, I'm going to use the spiders as a proxy for the SPX or S&P 500. It's just, an easier product to kind of interpret. And the most recent move, just to be fair, let's not say you caught it from the bottom, but let's say you caught some of that move from the 286 level, right? So we'll kind of enunciate that this is the 286 level, and this thing took off to the upside. Let's just come up with a nice big round number all the way up. We'll call it 307, which is pretty much where we reside in today's trading session. All right, so with that 307 all the way down to 286, what kind of a move, all right, are we really looking at? So 307, 286. Let's go ahead and throw up a little calculator here. 307 minus 286, just so you see where I'm getting the numbers from. Boom. Got about between a $21, $22 move. I mean, legitimately, we even got to the 308 number. So I'm comfortable saying it's between a $21 and $22 move to the upside. It's a one-directional move to the upside inside of the S&Ps. Now, time out. That's in the spiders. Let's call it a $21 move up in the spiders in the last 30 trading days. Okay, statistically speaking, does that happen often? Where are we? When I say statistically speaking, where are we? All right, one of the ways that many traders and investors alike would look at a marketplace is through varying degrees of what we term standard deviation. Now, let me actually describe this by drawing a standard deviation curve. Okay, so here's a nice big distribution curve. The question is, all right, so right now, okay, we're sitting right around 307. Okay, how far can this product move up or down within a given period of time? And specifically, this period of time, that period of time was approximately 30 days. I'm just putting it at 30 days because, look, it's right pretty much to the beginning of what? The beginning of October, pretty much to the end of October, so about 30 days. And that's 30 trading days, 30 calendar days. So in 30 days, how far can these spiders move? Well, I think that's a fair question to ask. And to answer that, I'm going to cruise over to the options market. In the options marketplace, I don't know, just look out 30 days. If you look at the 30-day options, okay, that's not going to be dissimilar to looking at 30-day implied volatility, which is the VIX, yada, yada, yada. What is 30-day volatility and 30-day expectation of price movement looking like? And it's somewhere between like $8 and $9. And again, I want you to see that. I'm just leaving the mouse on it for a second. Right there. We're just going to round that. We're just going to round that up. Okay, let's not get crazy. Let's just round it to $9. So we're supposed to move about plus or minus $9. Now, once again, in the previous month, we did not move $9. We moved about $21 or $22. And if you looked from the absolute low to the absolute high, we've moved from like the 85 level all the way to 308. You're looking even closer to $23, even $24 from absolute high to absolute low. But again, I'm putting it at about $21. So where does that leave us? And I think that the best place to kind of look at this is, first of all, we did all of that in the last 30 days, right? Instead of an $8 move, we had about a $22 move. Typically, how long does it take for a $21 or $22 move to happen? And if you look all the way out here, okay, at 100 trading days, you'll see it is about a $21 move out there. So what I want you to realize, and what really right now terrifies, okay, traders, all right, it's really, it comes down to this particular risk reward scenario. Now, most professionals, they don't often go into too much detail regarding this, regarding standard deviation and so forth, because they just kind of assume like, all right, most people are not going to get this anyway, so we'll just gloss over it. I think the best way to kind of describe this is, let's say that a normal move isn't even necessarily $9. Let's say it's $10. Let's make it even easier. Okay, so a normal move would be $10 higher or, okay, $10 lower. But we didn't move, okay, $10. We moved, for example, somewhere out here, which is $21. Okay, so if a normal move encompasses about 68% of all occurrences, all of a sudden we didn't move normal, we moved normal times 2. So instead of moving $10, let's say that we move $20, okay, that would encompass about what, 95% of all occurrences. We're all the way out here, right on the cusp, somewhere between a 2 and a 3 sigma kind of a move. Now, where does that leave us? Does it mean, just because the S&Ps are up over the last, what? They're up over the last 30 days, 21 points. Okay? Does that mean that we're going to tank? Absolutely unequivocally no. Okay? But it does give viability to a risk-reward scenario. And the risk-reward scenario is not favorable to currently be long markets. What's long mean? It means you own something. You have a 401k, you have a mutual fund, you own some stock. It is not favorable when the S&Ps are up 21 to be long the market. Why? Okay, from this point forward, could we go up another $21? Absolutely unequivocally yes. I will never tell you no. What are the odds of it? Statistically speaking, you'd have to like 0.001 would be something like, the odds of us going up another $21. On the flip side, okay, the probability again of us actually kind of pulling back, into a normalized standard deviation, considerably higher. From a risk reward standpoint, people, it doesn't pay right now to want to be long markets. So immediately, everybody balks at this idea, but immediately you look over here and you go, well, then who's buying up here? Hedgers are buying. Okay. What are hedgers? Well, first of all, I can tell you right now, me personally, I have negative delta in my portfolio. That means I am a bear. Okay. I'm a bear. I'm a bear. And you know what I do? Every time we go up, I've got to add sometimes a little bit of positive delta. And you ask, who's buying up here? Well, because I'm negative delta, which indicates that I've actually got bearish positions, sometimes when we go up, I got to buy. I got to buy a little hedge here, a little hedge there. Can you imagine trading firms? Trading firms are buying all-time highs all the way up. And all of a sudden, you start to squeeze. And the more we go up, the more positive delta I've got to add because I'm already negative delta. So I'm offsetting my risk in real time. Think about that scenario for a second, because it clearly enunciates who's buying at a point like this. But because we're buying doesn't entail that we're bullish on the marketplace. Quite the contrary, bearish. Okay? And I want you to think about, again, precisely the risk-reward scenario that I've laid out. As of right now, the markets, they feel a little docile. Okay? Nevertheless, we have bonds in motion, and this marketplace Don't let it catch you off guard. It's dangerous out there, people. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening.